Yeah, hi everyone. My name's PK, and here I have Brendan Colley. And today's episode is all about a look at stock or share investment versus property investment. And traditionally, people who sell property related goods or services or whatever, we're quite biased towards property. But what Brendan has done of his own accord, really, is create a quite objective and unbiased model over a time horizon, 20, 30 years with all sorts of assumptions to see, well, actually, does property win in the long term, short term, or does stocks or share investing win? And of course, we all know various pros and cons of stocks versus property. For example, one of the pros of property is leverage. Of course, you can leverage stocks as well, perhaps not always as much. But of course, leverage comes with risks. And if you look at the last 50, 100 years of the share market, whether it's global or local, there's higher volatility, which is obviously a proxy for risk, which real estate doesn't have. So that's one of the pros of real estate versus stock investing. Time, I think in terms of time, real estate loses out. It's a little bit more of an onerous thing to buy and hold a property than stock investing. Of course, there's always exceptions to every rule, but I'm just generalizing, painting a bit of a picture before we get into it. Value add, you can value add in property through renovations, development. You can, be in control of making money, whereas in stock investing, we can't really do so as much. And the control aspect is really where real estate comes into its own sort of strength, where you basically have control over that asset. Whereas if you invest in a company or a suite of companies, you're beholden to the management changes, policy changes, industry changes, sector, headwinds or tailwinds of the company that, is performing its P&L, etc. So you have less control. But ultimately, I think what people want to know is what's the financial result? All of these pros and cons notwithstanding, where am I going to make the most money? And I think that's where Brendan has done a terrific job. Just to introduce Brendan quickly, he's not a client of mine. I have no affiliation with him, nor is he trying to sell anything at all. He's just a humble dude, really nice and intelligent guy who works at, hope I'm allowed to say this, Brendan. He's a senior associate at Queensland Treasury Corporation, a place where I used to do an internship a long time ago. So he's just done this, I guess, as a intellectual curiosity piece more than anything. He's going to actually share the model on his screen. We're going to go through whether stocks versus property, which wins over time, with a whole host of assumptions. And I'm really excited because I don't think there's any content out there to this level of detail about pros and cons, which actually wins stocks versus real estate. Brendan, thank you so much for making time. It's 5 a.m. in Ireland where you're tuning in from.
Yeah, thank you, PK. And hello, everybody joining in. My name's Brendan. I'll just start by saying that I built this model of my own accord, and the results don't reflect that of my employer, Queensland Treasury Corporation. It's something that I've done completely off my own personal interest, so nothing work related. As PK said, I'm work in finance. I have an accounting and finance degree, and have in my working career have used Excel and financial modeling to serve clients. So producing something like this was a little bit in my wheelhouse, and I originally built the tool after a discussion with a colleague, and thought it would be interesting to see what the results were after a 30-year period.
Ultimately, guys, everyone who's watching or listening, we're looking for in the short, medium, long term, where do we make the most equity? Okay, equity is obviously the asset value minus any debt or liability that you have. So, should I invest in property or should I invest in stocks? Which is going to give me the most total accumulated equity? And the second question that we're trying to answer in this model, and of course, every model has its limitations, it can't answer every single question, is that after a period of time, if we sell down our properties or if we sell down our stocks or shares, in which scenario are we left with the most cash? All right. So equity and cash outcomes are really what we're looking for. Is that a fair sort of introduction of the model's intention, Brendan?
As well as, it was really important to me that the starting um, investment amount was the same. So I'll talk high level through the model now, just the general layout for people who are not familiar with financial modeling. So the inputs are over on the left. You can see those boxes in the that are highlighted yellow. They're variables that you can change, or a user can change to create a different outcome. Across the top, we have a timeline, which is from year 1 to 30, and the rest of the boxes that you see are output results that are being driven by the boxes in the yellow cells, particularly the starting cash balance of 75,000, which was an arbitrary number that I picked as if an investor was to invest 75,000 in either shares or property, what would the likely result be?
Right, right. I mean, I think the valuable discussion is around all of the inputs and sort of the assumptions behind the inputs, and maybe I can butt in every now and then as well. But if you don't mind, Brendan, scrolling to the bottom of the model just to show people what the charts look like, because I think this is what's ultimately important. And the first one at the top there to introduce it really quickly is the total accumulated equity. So over time, what's the decoupling, or what's the difference between your asset value and your amount of leverage or loan amount? And of course, that increases in both scenarios. But on the face of it, it looks like the orange line property seems to be beating shares. And we'll go through the assumptions in a second. And if we scroll down, just as a quick spoiler, total available cash balance after sales. So if we hold these assets, whether it's stocks or real estate, over the long term, whether it's 10 years, 15 years, 20 years, all the way out to 31 years in this model, once again, it seems like property is the clear winner, the clear favorite over shares. Now, of course, this is a model, and individual results can mean that some people may, flip these results around because of their expertise and experience and what have you. But I just wanted to show everyone these outputs, and now we can sort of debate and discuss some of the assumptions, which I think is the more interesting and valuable part of it. So if you don't mind, Brendan, if we go, perhaps we can start in the top one, which is the shares, the share inputs. If you can just take us through each of these.
Yeah, and I'll try and do this relatively quickly. I know that talking about financial modeling isn't interesting to everyone, so we'll aim to try and get through this as fast as possible. So, the starting loan to value ratio, that's just saying how much leverage is involved in the asset. I've set this to 0. You can leverage shares. I've done that myself in the past, but for most share investors, I'd say would be relatively uncomfortable leveraging shares, which
And do you mind? Sorry, I
the
might just interject every now and then, just for the health of the discussion. I hope you don't mind with that,
yeah, go for it.
Brendan. So, obviously one of the rebuttals that people might have is, well, you can leverage property. Obviously, in this model, property is a leveraged asset. Why aren't we comparing apples with apples? If we do in fact leverage shares to the same quantum as we're leveraging property, let's say 80, 90%, etc. Of course, most banks don't allow that. There are instruments that allow you to do it. I know you'll also agree with me, Brendan, and probably saying that the average mum and dad Australian, there's no way in hell they're leveraging shares at 80 or 90%. But when you did this model, and let's say if we were to create a hypothetical apples and apples example where we do leverage, that starting loan to value ratio is 80 or 90% for shares, does that materially change the graph outputs, like the outcome of all this?
I could do it if you would like. The reason I haven't done it is because most banks will only allow leveraging up to 70% for blue chip shares.
Hmm.
So I'd actually argue that you can't leverage a share portfolio beyond 70% with most major lenders. There are bespoke trading companies that let you trade, say, contracts for difference or equities that will let you leverage beyond 70%. But I don't think they represent a significant portion of the investor market.
I think it's interesting when I was playing around with this model that even if we consider quite an aggressive leverage profile of about 50% in shares, even with that, the total accumulated equity over the long term is not materially different between share investing and real estate investing.
So this is saying, if we go back to the assumptions for a second, so this is saying that we've used that initial $75,000 of starting cash to control a portfolio worth 150,000. That 150,000 is beginning to earn a yield of 5%. Those dividends are fully franked. They're not reinvested. So an investor is taking that cash out of the portfolio each year. And then they're paying, and then the portfolio is growing in price or value of 7.5% year on year. So under those assumptions, and they can be changed, but under those assumptions, which I've put as reasonably conservative, the equity growth over that time, the profile looks as follows. Now, people can argue that the assumptions should be different, and that's fine. But these are what I've put in.
Sure, sure. Yeah, I think that's very interesting. So even with leveraging shares up to 50%, it looks like property beats stock investing in both of these outcomes. Of course, there's other outcomes and other financial measures where by which you can assess, investing returns. But I think these are the two that the model seeks to try to find out. And I think in terms of some of those assumptions that you just went through, the net yield or dividend of around 5%, what do you make of that, Brendan? Do you think that's pretty representative of what we're seeing over the long term in Australia?
Yeah, I will admit I did this based on some past experience, so that may have changed. It's been a little while since I've owned shares either in managed funds or ETFs or direct equities myself. So, and this obviously changes. So between blue chip stocks, say Telstra, CBA, bank, mining shares, they may have higher dividend payouts than you would expect from, say, a startup company who's looking to reinvest that capital to grow their business. So this net yield or dividend percentage needs to be adapted depending on the types of equities that are being held in a portfolio. I picked 5% because that was what I remember getting from a high growth managed fund that I used to have some time ago.
Sure, sure. And obviously the individual tax rate at 32% is fine, and people can increase that or reduce that as necessary. It may need to be increased, if there's a big sort of sell-off event at a future year in time where there's a lot of capital gains on which to pay the tax. But I think importantly, you've used the same tax rate for the property example versus the investing example. So I think that's apples and apples. And the average growth rate per annum, I think that's pretty representative over the last 30 to 40 years, 7.5% per annum. Of course, if we go back to sort of mid 1920s and take the last almost 100 years, then actually it's surprising when I found this out, it's actually more than 11% in terms of local equities. And the same exists for real estate. So by and of itself, it's not like real estate grows more than stocks or vice versa, whether it's in the medium term or 100-year period of time. It's really a leverage story, I feel, that is separating the both of them. Was there anything else that you wanted to talk through in terms of the share inputs?
I'll just really quickly touch on what fully franked means. So this is an input that drives some of the model. In Australia, if you get a franked dividend, it means that the company has already paid tax on that income or that revenue earned, which means that the only remaining tax that is to be paid is the difference between the corporate tax rate and your own personal tax rate. So this row of line 12, that's what these numbers represent. They represent the extra tax that needs to be paid because an individual's tax rate is higher than that of a corporate tax rate. So just for people who may not be familiar with with that.
Okay, well, let's go down to the property inputs and sort of go back and forth to see whether they are pretty reasonable.
In the interest of time, I'll try and get through these. And if there's any in particular that you'd like to talk through in more detail, PK, then feel free to jump in.
Mm.
So once again, here, row 31, we see that the initial starting capital is 75,000. If that is used to purchase an asset worth $450,000, that will give us a leverage or an LVR of 88%. A rule of thumb that's used in the industry is generally 5%. That may be different. For example, if you're paying stamp duty in Sydney, it'll be different to if you're paying stamp duty in regional Queensland or regional Western Australia. That means that so once you take out the transaction cost, your remaining investment deposit in the asset is 52,500. The gross yield, so an important distinguishing feature between property and shares is that in residential property, it's mostly quoted in gross yield, which means that it's simply rent divided by the asset price. It doesn't include the expenses that are required to run a property. The rent growth rate, once again, I've put these in as what I considered to be conservative or reasonable, and open to opinion and argument on what others may think they should be. Capital growth rate I've put as 7%. A number that I've always used, property vacant each year. So just being conservative on, every couple of years in residential property, someone's likely to have a tenant change, and therefore there might be a week or two worth of vacancy. Interest rate on the lending at 6.5%. That's probably underrepresented. So for an 88% LVR, an investor in today's market is probably paying closer to 8 or 9%. The maintenance costs, that's in infrastructure or property, you can use a percentage of asset value as a rule of thumb. I've put it at 0.5 here, mainly for the outer years, because once the asset increases in value, that yearly expense looks excessive with a number that's bigger than 0.5. And then these remaining assumptions are the year one expenses, so as well as the amount of the fee that the property manager collects, assuming that someone has a property manager. I know that some people like to manage properties themselves. I don't personally. I like to pay a property manager. So that's just saying how much of the rent are they expected to collect for their services. And then the selling costs, once again, this is open to debate, but I put that down as 0.8, and I changed it around a bit. So that's just reflecting what are the costs to pay a sales agent to market the property, their commission, as well as their flat fee, trying to reflect that cost in the sale process.
Great, great. And I think there's probably many people watching this thinking, oh, probably not agreeing with some of these assumptions. And like Brendan said before, that's the idea of a model. So you can play around with the assumptions and really put anything you like in there, depending on your risk profile and your expertise. Someone may say that, a growth rate per annum of 7% is maybe too low. It's if you time the market, you can get above 10%. And I think that's the case for the share market as well. We've used 7.5% in the input for the share market for the average growth rate. And so, of course, some people will do better, some people worse. The idea of this is just to use an average. You can outperform the yield story as well. Gross yields at 5%. Personally, I probably would not buy a property with a 5% gross yield. But once again, we're trying to be reflective of something that's quite average, or average in the sense in a statistical way. And in Melbourne and Sydney, you're probably thinking 5% is way too high. And in other places, like perhaps Perth, regional Queensland, other places, you're thinking 5% is way too low. So once again, you can definitely outperform these assumptions. You can also underperform these assumptions, and that's the case for the share trading scenario as well. And I think you mentioned it really well. And I just want to clarify if anyone is maybe relatively new to property investing, the gross yield is 5%. It is gross, but then Brendan has netted that out through all these assumptions in terms of interest rate on the loan, maintenance, depreciation, council rates, insurance, water bills, et cetera, et cetera. And I think once again, the rent growth rate as well, it's up for debate. In the last 10 years, it's basically been, well, pre-COVID, it's been sort of CPI. Going forward, it's probably likely to be CPI times two. Who knows? Over the last sort of 30, 40 years, it has been sort of CPI plus just a little bit, 1 or 2 basis points. So these are all assumptions, but I think it's important just to be quite reasonable. And I think that's what Brendan has been in terms of these assumptions for both the share trading example and the property example. And if we go down to the charts, once again, it looks like property is, clearly winning under both scenarios or both outcomes in terms of total accumulated equity and also in terms of total available cash balance after sale. Now, I know that there's a couple of tricky things in this model that I found as well, and perhaps Brendan, you want to speak about them as well in terms of the reinvesting of dividends. Of course, in property, if we are building a positive cash flow portfolio, for example, which is quite hard to do right now, but over time it becomes positive cash flow as the model suggests. If we're making $10,000 positive cash flow from let's say from a property, it's very hard to go and buy another property for $10,000, right? You need to work up another deposit of, let's say, $60,000, $70,000, $50,000, whatever it is. But in stocks, if you get a dividend of $10,000 as an example, you can reinvest that, should you want, back into your portfolio quite immediately. And so, Brendan, if we do, there's that tab there, sell C12, I think it is, dividends reinvested. And once again, this is probably not apples to apples versus the property example now, but if we do flex that option and bring it to yes, how does that change things? And can you just explain sort of the rationale, anything more than what I've said?
We can do this in two stages. One with the dividends being reinvested, and we'll see what the outputs are. And then another scenario could be if you include the equivalent negative equity that you would use to own property to see what the outputs are. So if we reinvest dividends, so each year that's that asset value. So we started with $150,000. That $150,000 under a 50% leverage scenario gets multiplied by a net yield or a dividend percentage. And that spits out a dividend amount of, in this case, $2,250 for year one. We then pay tax on that, and then so our net proceeds are 2.2K. If that amount is reinvested, so if this 2,250 is reinvested, we still have to pay tax on it, but that would then grow the asset over time. So it's a bit like paying for cosmetic or maintenance, a bit like paying for maintenance on a property. So if we do that, if we reinvest those dividends over 30 years, you can see that the shares actually catch up a lot in terms of equity and the overall cash balance. And I'll just talk about the cash balance for a second. So the reason that the cash balance exceeds property over a 30-year period, and if people can forgive this error, it's because I've included a blank at the beginning of the series. But the reason is because that 5%, so if we compare the yields for a second, so if we've got a dividend, which is a net yield, which means there's no other expenses that need to come out of that, that's a 5%, comparing that to, remember, a gross yield in residential property of 5%. It means that the net yield for property is probably closer to either 1 or 0 or negative 1% on a cash basis. And that's why we're seeing this divergence over time between shares and property on a cash basis. It's because shares return more on a cash basis compared to property.
That makes sense. It's because, if there are dividends, and of course, not all stocks have dividends, and we're just probably assuming here we're buying a portfolio of companies or equities, and some of them or a lot of them are providing dividends. Whereas there's really no dividends, or huge dividends, I should say, from the get-go in a lot of properties. Of course, you can buy a positive cash flow property from day one. In these interest rate environments, it's more difficult. They become positive cash flow, but you can't then reinvest that back in sort of small increments of 5 or 10,000, and exactly like you said as well. That's one of the reasons as well why in that bottom chart there's that divergence between shares and property. The yield is better, categorically, in stock investing, providing you're buying the right equity with the right type of dividend. One thing I wanted to mention as well is that if we keep reinvesting the dividends, but if we go back up to the top of the model, and if I'm not mistaken, and we change the starting loan to value ratio to 0%, okay, so average mum and dad, I've got $75,000. There's no way in hell I'm leveraging that, because leverage means risk on the upside and risk on the downside. If you're overnight, there's a GFC or whatever, the portfolio value goes down 20%. Now, I'm underwater. The bank can come and ask for a margin call or whatever. It's quite risky. I go 0%, but I continue to reinvest those dividends. Then let's see how the chart transpires. And I think what we'll see is that it's a little bit different, right? It looks like property once again wins out. Okay, if before we were saying 50% leverage, okay, and we're reinvesting the dividends that way, looked like stocks were sort of catching up, definitely beating property in terms of cash balance after sale. But if you're a low risk investor, don't want to leverage up stocks, but you keep investing dividends, then reinvesting dividends, now that doesn't matter. Property still wins out. Is that a sort of fair assumption or fair conclusion or inference there, Brendan?
Yeah, that's correct. I'd argue that most mum and dad investors in Australia wouldn't apply any leverage to their share portfolio. And I recognise that there'll be people who watch this video who follow your content who do, probably because they have an interest in finance and investing and securing their financial future. But just for as a general assumption, I'd say that leveraging shares is not a common activity for most investors.
Sure. So it looks like property wins out when you do reinvest dividends back into your stock portfolio, which I would argue, I'm not sure, I don't have the statistics, but I would say more than 50% of average mum and dads probably wouldn't. They'd want to enjoy those dividends and use it for lifestyle reasons. Property wins out. But if you do leverage to 50%, which is unlikely, and reinvest, then that's where stock trading comes to its, sort of comes into its own. I think we did a fair job at sort of going through the different permutations in terms of reinvesting the dividends. And of course, there's other things that you can do with the model. But overall, like at a 20,000-foot sort of bird's eye view, when you built this for yourself, were you surprised at the outcomes or the outputs, or was it sort of matching your gut feeling before modeling it?
Yeah, I actually was a little bit surprised. I will say though that if you compare the performance of property against shares that are unleveraged, with dividends that aren't reinvested, and with cash flows, with extra cash flow each year not invested into that portfolio, uh, property well outperforms as we demonstrated.
Mhm.
But what I was surprised at was the performance of shares if dividends are reinvested and if an investor makes the equivalent cash flow contribution that would be required to hold an investment property. If they are disciplined enough to make that investment year on year for 30 years, then it's quite remarkable what that return profile looks like. So I just leave this with people to say that I did this as someone who's invested in both asset classes. I don't have an interest in pushing one asset class over the other. I'm now an active property investor because I would like to use the benefit of leverage. But in the past, I've used leveraging shares to be able to afford the investment properties that I now own. So I just did this purely as an intellectual exercise to have a conversation with a colleague.
Yeah. No, I think I'm sure lots of people at work, in finance circles or accounting circles have done similar models. I remember when I was a graduate in banking, we heard of a new company called Guzman Gomez, and we dis created a discount cash flow model to see how profitable it would be, and we said it was going to be quite good, mostly because the cost of goods sold with like Mexican food, like corn and beans, is like negligible. And I didn't invest in obviously Guzman Gomez, but I should have based on my model because they've obviously done really well. So there's merit in these models, but of course all models are limited. And I think my conclusion as well is, whether you pick stocks or property is a personal choice. Any individual can outperform the other based on their own expertise and risk profile based on that leverage story. But if I try to make this content as practical, viable, and implementable for an average sort of mum and dad investor, then I think, like you said, Brendan, most people don't want to leverage stocks at 50%, let alone 88% or even 10%. So if you've got $75,000, and once again, this is not financial advice, purely mathematically, you're probably better off. If you don't want to leverage stocks, you're probably better off according to this model, which may have holes in it, and people should do their own due diligence, investing in real estate. But once again, it comes down to your personal choices. For me, I didn't do such a sophisticated model when I made the decision of investing in property. For me, it was like, I don't want to go to sleep one night and wake up and have lost 20% of my wealth. So that was one of the key sleep at night factors, the reason I invest in property. But everyone's different, but hopefully this demonstrates that with even if you don't take 88% leverage, even with 80% leverage, conservative, everyone wants to put down a 20% deposit, right? 80% leverage in property, you're outperforming an unleveraged stock portfolio. You're also outperforming in a lot of way a small or a sort of shallow leveraged stock portfolio. It's only when you leverage up stocks and you reinvest those dividends diligently every year that you can outperform property. But once again, the assumptions that we've used for rental growth, capital growth, share market growth year on year, these are just assumptions, and you can outperform them and underperform them. But a model is meant for, if you put in different assumptions, seeing what the what if scenarios are. I think that you've done a terrific job, Brendan, and hopefully this has brought a lot of people a lot of value. How did that discussion go with your colleague, when you actually did complete the model? I don't know, were you guys tussling it out, or which side were you on versus him? How did that finish up?
Yeah, so the context behind how the model came to be built was I was fairly confident in property's ability, partly due to leverage, which does come through in the model. That the first 15 years in particular, you really see a gap between shares and property on the equity that's generated. One thing that the model doesn't do, which would be a useful exercise, would be if that equity is then reinvested into other properties or used as capital to grow the portfolio, you would see a further divergence between the performance of property and shares. Um, I left the conversation with my colleague a bit more open minded to kind of safe levels of leverage with share investing. It's not something that I will be looking to actively pursue straight away. I've got an interest in other asset classes, such as commercial property, but I can see the merit in safe levels of leverage. I use the word safe a bit loosely. That's up to each investor's risk tolerance as to how much, or if they're willing to entertain any leverage. So, I'm glad I did it. The work has been interesting, and I've been able to share that with some people to hopefully add value to help them in their decisions.
Amazing, amazing. And as you said, Brendan, there's no right or wrong. You can use stock investing to bring a $20,000 deposit up to a $60,000, $70,000 deposit, and then get into the property market. There's also lots of people who use property as their mainstay of generating equity or generating net wealth. And then in their later years, they sell them down and they put them into more passive assets like managed funds, ETFs, which give a higher sort of yield or dividend. So there's no right or wrong. I think both are interesting. I'm almost 100% in terms of my own portfolio in property, but I think you have to go with what you think you're good at. And I think I'm better at property than stocks. I did try stocks back when in my investment banking days, and even with all the contacts and information and modeling and everything, I still couldn't make a buck. So I know where I know where I stand. But hopefully that brings everyone a lot of value. Brendan is part of the Facebook group Australian Property Mastery with PK, and he actually posted this model in there. That's where this sort of conversation, that's the genesis of this conversation. So you can find that shared, pictures of this model shared in the Facebook group, and there's a whole bunch of discussion there. And I think Brendan's also very kindly shared the model for people who want it. Hopefully, I don't know if I want to mention this, but you could ask him if he wants to. He might inundate him with hundreds of requests, but anyway, it's up to him what he wants to do. But at the very least, there's a good sort of thorough, robust discussion in the Facebook group. So once again, on behalf of the community for whom we've really done this, thank you so much, Brendan.
It's okay. Thanks for having me, PK.
And thank you everyone for watching or listening. I really appreciate it. Hopefully this was unbiased and not so partial. I'm always talking about property, but hopefully this sort of did sort of illuminate or create some light around why property is so attractive for a lot of people, and equally why stock investing is really attractive for other types of people. Hit the like button, hit the subscribe button. If you have any comments or questions, follow-ups, obviously it's very hard to do on YouTube and places, but go into the Facebook group and ask there. We can have a really robust discussion. Thank you again, and thank you again, Brendan. Appreciate it.
Thanks, PK.